Buying a house is one thing, but knowing what to do when you've got some extra cash each month is completely another. Do we take the extra cash and use it to pay down our home loan extra fast? Or do we take the extra cash and use it to get started investing so that compound interest can work its magic? Get this wrong and you could waste years and potentially hundreds of thousands of dollars. So in this video, I'm going to share with you a very simple, no-fluff approach to working out which strategy is best for you. We're going to have a look at risk tolerance. We're going to have a look at your time horizon. We're going to look at interest rates, and we're going to look at a balanced approach that works really well in the real world. Now, I've spent the last 35 years helping everyday families take control of their finances. I've had the privilege to see dozens of my clients pay off their home loan inside 10 years. I've also managed hundreds of millions of dollars through the ups and downs of the economic cycles. And I have also had the privilege to help hundreds of my clients work through this exact decision. What do I do with my extra cash? Do I pay down my home loan faster, or do I get started investing? Now, if after watching this video you would like to learn more about how do I get started investing, or perhaps how do I pay my home loan off faster, then can I encourage you to check out the link in the description below to my Money Boss Academy, which is a step-by-step plan for helping you make the most of your finances so that you can create a life that you absolutely love for yourself and your family. Okay, so let's go through the agenda. Firstly, we're going to look at the important steps you need to take before you consider investing or paying off the mortgage. We're then going to have a look at mortgage maths in plain English. We're going to look at when investing usually wins out. And we're going to look at the risks that most people forget when making this decision. And lastly, we're going to look at a balanced split strategy. We're going to run the numbers on 3 different scenarios, so it is really worth your while hanging around to see those results because they're very interesting. And then we're going to recap and summarize things briefly. Okay, so let's have a look at the first step that you need to take before you do anything. Now, I don't want to spend too much time on this. On the right-hand side here is a financial roadmap that I take all of my clients through. I've evolved and developed this over 35 years of financial coaching. It is very, very powerful. But today we're just going to look at the first 5 steps here. And that is before you get started investing, before you think about paying down your mortgage, there's 5 things that we need to do. Firstly, we obviously need to make sure that our income is greater than our expenses. Now, the fact that you're watching this video suggests to me that you already have some surplus cash flow, which is amazing because that puts you way ahead of most people. You've got some surplus cash flow, but step number 1, income has to be greater than expenses. Number 2 is that we need to make sure that we've got some kind of budget or money management system that ensures that you know you've got all of your known expenses covered. There's a bank account there, a budget there, that you are absolutely confident that there is money set aside for your known expenses so that when they turn up, the money's just there ready to go. Second thing is we need a rainy day fund because unexpected expenses can and will occur. 10 to 15% of your expenses every year will be unexpected. These are things like the dog getting sick, the car breaking down, the fridge breaking down on you, the hot water system dying. These things will happen, so we want to make sure that we're not pulling money back from our mortgage to pay for those, or we're not pulling money out of investment to pay for those. We need to make sure we've got a rainy day fund. Then, of course, we need to eliminate high interest debt. There is no point paying down your mortgage, which has a rate of, say, 6%, if you've got interest over here on a credit card that is charging you 18%. There's also no point starting investing and getting an average return of, say, 9, 10, 11% if you're paying 18% on a credit card or 10% on a car loan. So let's deal with the high interest debt first. And then we need to make sure we've got a cash reserve. Now, a rainy day fund is for unexpected expenses. A cash reserve is for unexpected life events. Things like you getting sick or injured and you're not able to work for a period of time. Or perhaps you lose your job. Or perhaps you need to take time off to care for a loved one. Important that you have a cash reserve, ideally equivalent to about 3 months worth of your expenses, at least 3 months worth of your expenses in place before we consider investing or paying down the mortgage. Okay, so let's leave that there. That's your foundation first. So let's check out the mortgage maths now. Now we're going to go through this very quickly because I'm assuming that you probably know most of this, but it's always good to have a refresher. So let's assume that we've got a $600,000 mortgage over 30 years, so 360 months, at a 6% interest rate. Over that time, your repayments are going to be $3,597. And that means you are going to pay, and this is where it gets a bit scary, $695,000 to the bank in interest, which means that your home loan is going to cost you close to $1.3 million if you let it run the full 30 years. Now, if you think about it, that 1.3 is after-tax money, which means you actually need to earn about $2 million to then have $1.3 million after tax to then pay off your home loan and the interest that goes with it, which is pretty scary. So paying down your home loan extra fast is certainly a smart move, but we're going to look at whether it's the best move in just a moment. Okay, let's look at the interest calculation. How is interest worked out on your mortgage? Well, we've got the formula is the balance owing, so how much do we owe on the mortgage? What it times by the interest rate and then divide that by 12 to give you a monthly figure. Very simple maths. So if we've got a $600,000 mortgage at 6%, our interest rate's going to be, our interest is going to be about $36,000. If we divide that by 12, then we can see our interest for this month number one, will be $3,000. So if we have a look at an amortization schedule here, and this is where it gets a little bit depressing. You can see if our home loan repayment is $3,597 in month one of our mortgage, $3,000 of that is going to be interest and $597 of that is going to be principal. So in other words, money you're actually paying off the mortgage, which is very sad. Now, the reason I'm sharing this with you is because I often have couples who come to me and say, oh, Phil, well, we're going to get this home loan, and within 5 years, we anticipate that we paid it down quite a bit. There should be some equity, and at that point, we should be able to do some renovations, and we may be able to refinance and all those sort of things. But the sad reality is in the first 5 years, you paid barely anything off your home loan. In fact, it's not until month 223 that your interest... so your interest becomes less than the principal payment, or your principal becomes more than the interest component you're paying. Month 220, that's almost 20 years into your mortgage. The bank front loads the interest to protect themselves. They make sure that they've got their profit first. Really important to understand that. And again, this is why paying down your home loan faster is always a good option. Again, is it the best option? We'll have a look at that. But certainly not allowing your mortgage to drift for 30 years is a very wise move. Okay, one tip that I was taught very, very early on in life is that if you can simply just double the principal component each month, then you're going to end up paying your mortgage off in half the time. So if we have a look at this example here, you can see our mortgage repayment is $3,597. $3,000 is interest, $597 is principal. If I just said, okay, well in month one, I'm going to put an extra $597 off my mortgage. In month two, I'm going to pay an extra $600 off my mortgage. In month three, I'm going to pay an extra $603 off my mortgage. If you can just do that, here's the example again, $3,000 in interest, my principal is $597, I'm going to pay an extra principal payment. In month two, it's $603. In month three, it's $609. If I double that principal payment, I will pay my home loan off in 15 years and 1 month, and I will save myself about $345,000 in interest. Such a powerful way to approach your mortgage. If you can just do that, you're going to save yourself hundreds of thousands of dollars, which is not such a hard thing to do if you just get focused. Okay, now let's have a look at when investing usually wins. So what we're going to do here is we're going to compare two numbers. Firstly, we're going to look at what the average return on the Australian share market has been over the past 30 years. And you can see here, according to Vanguard, it's about 9.2% has been the average return over the last 30 years. If we look at the average Australian home loan rate, so what are you paying in interest on your home loan? It's been around 6.7% over that same 30 years. So you can see there's a 2.5% difference between those two. And over time, that 2.5% difference can compound significantly. But let's have a look now at what this looks like if I had an extra $500 every month, over and above what I need in my budget. It's purely surplus money, and I was to put it into the share market. Let's say we went into an Australian index fund or something like that, and we expect 9.2% over that time, $500 every single month. You can see that what we would end up with is $962,235, which is not a bad return just for that extra $500 every month going into the share market, dollar cost averaging. Oops. So let's have a look now at, okay, well, what about if I took that same $500 and paid it off my mortgage? So what we've got here, $500 into our $600,000 mortgage. Interest rate is 6.7%. So we're using 6.7% now, not the 6 we were talking about earlier. 6.7%, which is a long-term interest rate. $500 every month. You can see down here that we would save $252,391, and it would save us 8 years and 2 months off our mortgage. And you go, wow, okay. That's nice, but that's nowhere near the $960,000 you were just showing me by investing, Phil. And I get that. So you go, well, isn't it a no-brainer? Shouldn't we just invest? But there's one thing that we're forgetting here. You have 8 years and 2 months extra where you can take all of the extra repayments you are making off your home loan. So all the extra payments, so the basic home loan plus the extra payments you're making, and you can now invest that as well for the next 8 years and 2 months, so that we're comparing apples with apples. So if we were to do that, here we've got $4,371. So that is what we were paying off the mortgage with the extra payments. Over 8 years, earning 9.2%, that would actually return us about $625,000 because of the size of those extra payments. If we look at that and we go, okay, well, that's how much we'd get in shares, and I also saved myself a bunch of money in interest on the mortgage. In total, those two add together to be $878,000 over that 30 years. So there's now not such a big difference. In fact, it's an $84,000 difference between just putting it all into the share market or putting it all into the mortgage. So $84,000 sounds like a lot of money, but over 30 years, it's probably not a huge amount. So let's now have a look at, there's some other things we need to consider here. Let's have a look at these risk factors that we fail to consider. Number one is that markets don't move in straight lines. Number two is that interest rates and inflation are likely to go up over the next few years. Number two is we mustn't forget about tax. And number three, there are fees and penalties that we need to consider. So let's have a look at these in more detail. Number one, share market doesn't go up in a straight line. This is one of my favorite charts. Unfortunately, I couldn't find a more recent one. You can see over here, we're about 5 to 10 years out of date. But what it does show is the big dips we've had in the financial markets along the way. So you can see back here in the 1970s, we saw the share market fall 65%. In the early 80s, we saw it fall 43%. We had the 1987 stock market crash, which fell 46%. And then we had the GFC, which fell 50%. And since then, we've had COVID, which fell around 40% as well, and then recovered very quickly. These things happen on a regular basis, and I would suggest that we're not far off seeing another one very, very soon. So what you've got to understand is that it's not as simple as I put my money in the market, it earns 9.2% per annum, and it's all hunky-dory and we're all happy with the outcome. Understand there are going to be years where it goes up 30%, there's going to be years where it drops 40, 45, 50%. That's just the nature of the share market. Now, the important thing to understand here, though, of course, is this is a logarithmic scale on the left-hand side. So it goes 100, 1,000, 10,000, 100,000. So it's actually being compressed the higher it goes, simply so that this chart can fit on the screen. The reality is it's actually way through the roof if we didn't have a logarithmic chart, which shows that over the long term, and this is 128 years or 125 years here, over the longer term, 135 years, it does go up. But it's not a straight line, so you've got to understand your risk tolerance to that. How are you going to feel if the market drops 50% when you're investing? If that causes you a huge amount of concern, then maybe just paying down the home loan is a far better option and gives you a much greater degree of certainty and peace of mind. But just understand this does happen. The second thing we need to factor in is that inflation and interest rates have been at record lows in recent years. So in the last 10 years, actually over the last 30 years, inflation has gone from a peak of sort of 17, 18% down to a very low level, down around that sort of 2% mark, 1.5% to 2% mark. So when your mums and dads or your grandparents said, well, when we were young, we paid 16, 70% on our home loans, that's absolutely true. However, home loans were a much smaller portion of our household income way back then. So it was easy to deal with those kinds of interest rates. But the thing that I want to point out here is that interest rates may dip in the short term, but I would suggest, given the amount of money that has been printed around the world to get us through COVID and get us through the GFC, inflation is actually going to rear its ugly head at the bottom of the next cycle and then start moving up quite sharply. And do not be surprised if interest rates are looking around sort of 8, 9, 10%, not the 5.5% that we've got at the moment. So you just need to factor that in. Then we mustn't forget tax. Now, if we pay off our home loan, money saved is not taxable. So we're saving money on our home loan. That's not taxable. Whereas whenever we are earning money, there's both income tax and capital gains tax that we need to take into the equation. Now, when you invest in shares, when they pay you dividends, that's some of the earnings that the company's paying out to you. Because the company has already paid tax on those earnings, they will pay you a tax credit for that, which is what's called a franking credit, which will mean the tax you actually pay on the earnings is significantly less than what you would think, and certainly less than what you pay on other investments. There's also the capital gains tax discount that you can get if you hold an investment for longer than 12 months. Then the gain is halved and then you're taxed on that half the gain. So there are some tax incentives, but it is still important to understand that when you're investing and earning money, there is income tax to be paid, and there's quite likely going to be some capital gains tax at some point as well. So we need to factor that in. And then the last thing is taking a look at the fees and penalties, particularly on your mortgage. The banks do not want you to pay your home loan off faster. They make hundreds of thousands of dollars on your home loan over time. They like it that way, so they're not going to make it easy for you to pay your home loan off faster. So you need to think about, well, am I even allowed to pay my home loan down faster? If you're on a fixed rate home loan, then chances are you're limited in how much extra capital you can pay off that home loan. It's probably around $10,000 a year max, or $15,000 that you're allowed to pay in advance on that mortgage. So figure out what that is first. There may also be break fees or early payout fees if you try and pay your home loan off early. So just make sure that you're aware of what those might be before we go gung-ho at the mortgage. Okay, so they're the risks that we need to consider. Now what I want to do is take you through a balanced approach, a balanced thought process with this, and we're going to go through some real life examples here. Now, one thing that's really important to understand is that it's not all or nothing. I think sometimes we think we should either invest in shares or we should invest in property. Invest in shares or we should pay down our home loan. Now, if we have a look at those examples that I gave you earlier, it ended up being about an $84,000 difference over 30 years if you went all mortgage or all investing in shares. But what I want to present to you now is three different options. One is that let's just say we're very conservative, we like our certainty, maybe interest rates are quite high at the moment, and we're going to be a little bit more risk averse, and we're going to pay 70% off the home loan and 30% put that into investing. Can I also say, I don't mind the split approach to things because it makes us feel like we're diversifying and we're doing something wise with our money. But also, we then get the process going. Like we start investing, and I think sometimes one of the hardest things for people the biggest obstacle to overcome is actually just getting started. I don't know what to do. I don't know where to invest. I don't know how to invest. And so we just put it off, and paying down our mortgage is just the easy default option. Now, that is okay, but I actually think that at some point you're going to need to invest to ensure your money can stay ahead of inflation. So learning how to do that, getting started as soon as possible is a really good thing, even if it's just a little bit of your money going into the mortgage to start with. Okay, then we've got the mid option here, which is we do a 50-50. So maybe we're a bit, blasé. We don't really care which option we choose. So we're just going to 50 off the mortgage, 50% into the home loan, into investments. And then the third option here is we're a little bit more aggressive. We've got a higher risk tolerance. We don't care about the fluctuations of the financial markets. Maybe interest rates are quite low on our home loan at the moment, so it just makes more sense to invest. But either way, we're going to choose to put 30% into mortgage and 70% into investing. So let's have a look at what the numbers look like with that. So what we've got here is 70% into the loan. So we're going to, some things I just want to be clear on here. We're going to invest, we've got $500 extra. So we've got to decide what to do with this $500. We've then got the interest rates on the home loan at 6.7%, so the long-term 30-year average, and we've got rate of return on investments at 9.2. So they're the variables that we're working with. So let's have a look at this. Now, there are three different components to the calculation that we're going to work through. The first one is okay, if I pay, in this instance, 70% or $350 off my mortgage, what's it going to look like? How much money is it going to save me, and how much quicker am I going to pay my home loan off? Then we're going to have a look at, okay, well, what about the 150 we put into our investments earning 9.2% per annum? What's that going to look like? And then once we've got the home loan paid off, so we're going to pay that off a bit faster, if we take all of that extra mortgage repayments and throw that into the portfolio, how much extra is that going to add to our eventual outcome? So those three components, I hope that makes sense. So what we've got here is we've paid $350 off the mortgage, so extra $350. The mortgage repayment itself, standard repayment, is $3,871. We're paying an extra $350. So you can see here that we're going to pay our mortgage off 6 years and 4 months earlier, and we're going to save ourselves $197,000 in interest. Which is money the bank doesn't get and money that we get to keep, which is fantastic. So if we have a look here, okay, there's $150 now that we're going to put into the share market, into, let's just say, an Australian share index fund, $150 every single month at 9.2%. That's going to return us $288,000 over the same 30-year period. So if we add these two together, 288 plus 197, that's going to give us about $485,000. But there's one last step here, and that is I've got 6 years and 4 months where I can take all of my, what were my home loan repayments and extra payments, and I can put that into the share market. So if I did that, monthly deposit of $4,221 at 9.2%, that's going to give me an extra $433,202 in that 6 years. So if we have a look at the total return, if we add 197 to 288 to 433, what we end up with is $919,000 from this particular strategy. And remember, this all just comes from having an extra $500 per month that over 30 years, it's going to reap for us $919. So let's have a look at the next strategy, and that is a 50-50 to the investments. Sorry, 50 to investments, 50 to home loan. So $250 into each. What we've got then here is a loan amount, $600,000. The standard repayment is $3,871, and we've got extra payments of $250. So that means we're going to pay our home loan off in 4 years and 11 months faster, which will save us $153,000 in interest. Now let's have a look at what the shares would look like. $250 every single month into the shares at 9.2% would give us $481,000. If we add those two together there, you can see we've got about, $635,000. And then we've got 4 years and 11 months where we can take all of the extra home loan repayments, put that into the share portfolio as well, and that would reap $305,000 over that 4 years. So we add together 153 to 481, 305, and that gives us then a total outcome of $940,000. So if you remember, the previous strategy gave us about $920,000. This one's giving us $940,000. So we're $20,000 better off over that 30-year period. So let's now have a look at the more aggressive strategy, and that is 30% into the home loan, so 150 extra off the home loan, 70% into the investment portfolio, so 350 in the investment portfolio. What would happen here is we would save $101,000 in interest. We would pay off the home loan 3 years and 2 months faster. If we look at the share portfolio, 350 into the shares at 9.2% would give us $673,000. So if we add those two together there, you can see we end up with about, $700 and let's say $75,000. But we've then got 3 years and 2 months of extra payments, which would give us $176,000. If we add those together, you can see here that the outcome is $951,259. So I hope you can see here the difference between the first strategy, which is 70% off the mortgage and 30% into shares. That yielded us about $921,000. And we look at this strategy, which is 70% into shares and 30% off the mortgage. It gives us $951,000, which is really only $30,000 difference over 30 years, which is not significant. And I want you to understand this, that the actual numbers themselves, the actual financials themselves behind this, aren't the important factor in this. The important factor in this is what gives you peace of mind. What is going to give you the greatest sense of peace when it comes to how you manage your money? What's going, are the fluctuations of the share market just going to freak you out? Or are you going to feel like you're missing out if you're watching the share market growing and all you're doing is paying your mortgage off over here, but the share market's doing 20, 30% per annum for, 2-3 years straight? Which is going to make you feel most comfortable? I do believe that that a mixed strategy is not a balanced strategy, is not a bad idea, as I said before, simply just to get an investment portfolio started. As I mentioned earlier, I do believe that we're going to see a pretty rough 2 to 3 years in the years ahead. So it's currently September 2025. I don't know when it'll start, but I do think the next 2 to 3 years could be pretty rough. Potentially paying more off your home loan and then coming back to the investments or more of the investments at a later date might not be a bad thing, but you've got to decide what is right for you. Now, I'm hoping that this has been helpful so far. If it has, please click the like button because that helps this content and my channel reach more people. As you know, my heart is to help as many people as possible make wise financial decisions so that they and their families can thrive financially. So please, if this has been helpful, click the like button and don't forget to subscribe because every week I'm putting together practical no-fluff money videos to help you take control of your finances, get out of debt, and consistently save more money so that, again, you can create a life that you love. So please subscribe to the channel. Now, let's have a look. Let's summarize all of this. Let's go through and look at, okay, how do we put this all together? How do I decide which is best for me? So if we have a look at the summary, if rates are low, interest rates are low, like they've been for the last sort of 5-10 years, and you've got a long-term time frame, then perhaps investing is not such a bad option because the differential between what you're paying on your mortgage and what you can get in returns that in the share market are quite large. So it's not just that 2.5. Maybe if you're paying 3% on a mortgage and interest rates, returns on shares are 9%, well, that's now a 6% gap, and that can start to sway things in your favor if you invest. However, if we're in a situation where interest rates are quite high or getting higher, and you like certainty. Now, I'm one of those people that like certainty. This is why we paid our home loan off inside 7 years. I love knowing that we've got our home loan paid off and we're completely debt free. If that's you, then maybe paying the home loan off fast, especially if interest rates are high, is not such a bad thing. What we want to do then is understand that it's not all or nothing. I do think that having some kind of investment portfolio set up, just dollar cost averaging into shares. Now, there are videos here at my channel about what is dollar cost averaging, what are index funds, how do I get started investing. So please make sure you check those out. But it doesn't have to be all or nothing. It can be majority of the mortgage and a little bit into shares, and it can be the complete flip of that. So don't think it has to be all or nothing. Always make sure you build your emergency fund first, because what happens is if you've got an emergency fund there, then it just gives you a sense of peace that, oh, well, if the share market absolutely tanks, it drops 40, 50%, it doesn't matter. It's not affecting my day-to-day. I know it'll go back up long-term and I can afford to wait. Same thing with if for some reason interest rates start to go up quite sharply. If you've got a cash reserve there, then look, it doesn't matter. If I have to dip into my savings a little bit to cover the shortfall, I am okay. So what an emergency fund does, it just gives you this platform where you don't need to stress about whichever scenario you end up choosing. Do whatever gives you the most peace, okay? Life is living here and now. So often I see people who become slaves to their assets and they're putting themselves out there and they're really stretching themselves. They live these really stressful lives because of their finances, hoping that one day, this magical unicorn moment in the future, everything will be good and we can live comfortably. And yet they forget that living is what you do today. So always choose the one that gives you the most peace, because you've got to live with it on a day-to-day basis. Anyway, I hope this has been helpful. Thank you so much for watching this video. If you would like to learn more about how to get started investing or pay off your mortgage super fast, then can I encourage you to check out the link in the description below to my Money Boss Academy. You can see this is something I'm very, very passionate about, helping everyday families create lives they absolutely love because they've got the basic financial structure, the basic financial framework in place, and they're being proactive with their money. Now, please remember that it is the little steps, the little actions that you take today, the little habits you put in today can literally make $1 million difference to your future. So please take action, and I look forward to seeing you in the next video.